Hi, everyone. Clark Harvey here, the owner of First Rate Mortgage, also known as the Barbecue Mortgage Guy. My NMLS number is 240452. We are an equal housing lender. Okay, so today we're going to talk about using the all-in-one loan for a purchase. And I qualify individuals with 3 questions before I even have a conversation with them. And I'll ask them, do they have 10 to 20% to put down on the home? And we're going to do this as a primary residence today. And also, do they have at least a 700 credit score? So if there's 2 people on the loan, we get 3 scores each. The middle of the scores, whichever 2 is lower, that's when we go off. So we need at least a 700 credit score for the program. And also 10 to 15% in reserves. And to keep numbers simple math, say, for example, the loan amount's $100,000. We need to have them have $10,000 to $15,000 in reserve. And what that means is after they put the down payment, closing costs, they need to have $10,000 to $15,000 in reserves. And the reason why you say 10 to 15,000 or 10 to 15% is the key. So if it's a different loan amount, just calculate the numbers, and that gives you your dollars. This program can also be used on a secondary and or vacation home and investment property. The criteria is slightly different on investment property and secondary homes, but we'll get into that later. All right, so to start off with, we're going to go to my website, which is firstratemortgage.com, clarkharvey.com, thebarbecuemortgageguy.com. And we're going to click the tab Investors right here. And we're going to start this program saying get started. So again, this is a comparison between the all-in-one loan program and another purchase program that the client might be looking at, whether it be a 15-year fixed, an ARM, 30-year fixed, 20, whatever. So we're going to select, it's a new simulation because it's a new one, and it's also a purchase. So that's the new loan. The existing would be a refinance. And again, it's a primary residence. We're going to say fairly typical scenario right now. And again, most likely not for a first-time home buyer, this program. This is a little bit more advanced. And we're going to say this individual, and again, this is just a scenario, individual is going to put down 20%, which would make the loan balance at $560. And we're also going to say that this client, we're going to compare it against a 30-year fixed. Say the rates are 7.75, that's where we're at the moment. So that means principal and interest is going to be about a little over $4,000. They're going to pay their own taxes and insurance on this loan program. It's not going to be an escrow account. We're going to click next. It's going to talk about deposits. Now we're going to talk about net deposits, not gross. So whatever's being deposited in there, we're going to say this individual deposits $5,000 twice a month. So that's semi-monthly. If it's weekly, obviously it's once a week. If it's bi-weekly, it's 2 times a month. Or excuse me, every 2 weeks. Or it could be monthly, annually, semi-annually. We're going to say semi-monthly. One-time deposit is something that is going to be, for example, a bonus, quarterly bonus, maybe an annual bonus. So we've got that put in here now. Next is, it shows $10,000 monthly net deposits. Estimated tax and insurance, we're going to say around something in that neighborhood. Somewhere is going to be around $375. We're going to use a percentage of monthly deposits left over. Again, if you have questions, you can read this right here about spending. No sense in doing that right this moment. And we can also itemize that in detail, whether the spending is weekly, monthly, whatever that looks like. We're going to put in a percentage. We'll say they're not spending all their money. And again, the power in this is the all-in-one. So meaning it's a bank account that's a sweep account that sweeps any money deposited in there directly to the home equity line of credit. So it's a first position home equity line of credit along with the bank account. So all those deposits, keep numbers simple. I'll just give you a visual. If you have a $100,000 loan amount and they're depositing that $10,000 a month, Then it's going to sweep directly onto that loan balance. And now it's going to be at $90,000. And so interest is calculated on that on a daily basis. So therefore, it is an adjustable rate mortgage, or an ARM. And it doesn't matter necessarily what the rate is, although it does have a floor and a max. And I'll get into that later. We're going to say these people are not spending all their money, because if somebody's living paycheck to paycheck, spending all their money, they're probably not great for this program. And you can click on future one-time expenses, that may occur. We're not going to get into that necessarily. To keep it fairly simple today, we're going to calculate the results. In this person's case, this is how it looks when you click the results. So we started here, got started. We started comparison loan, the deposits, what their spending is, and the results is this one right here is your traditional 30-year fix. And again, we use 7.75 as a rate. So their total expense on this loan to get it paid to zero is over $1.4 million. Total expense on the all-in-one loan is a little over $900,000. Therefore, saving your client almost just over $500,000 and paying off their house in 11 and a half years. That also means they have money to spend to buy other things. That's the whole beauty of this program. Really, this is key to an investor, whether they're investing in real estate, the market, whatever that looks like. This is a phenomenal program, because most people think, okay, I'm going to get my house paid off, so I pay extra principal payments. And when they do that, that's great, because it'll help pay it off a little bit quicker. It's a slow crawl, but the money's all trapped in there. What if life happens? You get in an accident and not able to work. God forbid you get sick and not able to work. And another example, what if one of the spouses pass away? What if it's an income earner that passes away? The income stops. Well, I can give you an example, live example of an individual who had this loan, a couple. They had it few years in place. Unfortunately, the husband passed away unexpectedly, and they were so far paid ahead that the wife or the spouse did not have to make a mortgage payment for over 3 years. So she went back to college, got her degree, and was still able to stay in the house. If you have a term loan, 15-year fixed, 30-year fixed, whatever that is, and you don't make that payment for 3 months, you're going to get a knock on the door, a letter or an email or phone call from the lender saying, we're going to start foreclosing on your property. And you may possibly lose that home. So that's a side benefit I want to share with you guys of why an all-in-one program is a phenomenal loan, because life does happen. And we're in the insurance business, and we want to protect people and help them retire well and make a great income along the way and make great family memories. So one of the lines I use to individuals when I'm doing this presentation is say, hey, consumer, would you be willing to open up a new bank account if I gave you over $500,000? Their answer is most likely going to be yes. And that's literally what we are doing. Now, this is just a scenario. And so things change, but it gives the consumer an idea of how this works. We're going to click on rates and assumptions. Rates and assumptions, we're assuming some things. Again, this is the primary residence, 1 month adjustable, leave the margin at 4. Their credit limit is actually going to start out at 630, even though the loan amount's at 560. You can see right here. The floor rate, we mentioned this earlier, is 3.75. So that means that's not going to go any lower than 3.75, period. But it also has a max rate. And most credit cards do not have a max rate. And most HELOCs have typically they're around 18% as a max rate. This one's at 15.4. And here's some other things as well. And I want to touch on this with these little eyes right here. You can click on every one of those, and that goes, what's the intended occupancy? And so it'll kind of go over the description and all that. Okay, so what is a maximum rate? What is a floor rate? All those things that helps you and myself to explain to the consumer. And again, this will, when we're done here, it will create a key, personalized key for that individual that we can give to them. They can go back in here and kind of play with some of these numbers. Well, what is an index? Well, it's going to talk about what an index is. It's going to talk about what the initial rate is. This is the sum of the margin rate and index, or the floor rate, whichever is greater. Some people ask, well, why would a bank do this loan? They're not going to make as much money. And what I tell them is that this bank that does these, they've had 0 defaults in 18 years. That's 18 years, 0 defaults, and nobody closes these out. Why? Because they're so powerful. Why would you close them out? The other benefit is you can have investors use this to go create more wealth, whether to buy more real estate, they invest in the market, an IUL, whatever that looks like. That is something that is a potential benefit for them. Okay, so let's talk about this historical graph. I also talk about this as well. What that historical graph is we're going to talk about the last 25 years, what the average rates have been. So the history is, and this is just math, numbers don't lie. A 30-year fixed rate mortgage for that past 25 years is average 5.71. Currently, or last month, is about 7.2. It's a little higher right now, as you notice, we put in the higher rate. Effective funds rate and the 1-year CMT rate, or the index, the average, historical average, and current. If you want to get into the detail of what those are, it's all right here. It explains it with constant maturity and the federal funds rate. So that gives a snapshot, and you can see the orange and blue is lower than your Fannie Freddie rate. That's a conventional loan. So it kind of gives in here this criteria. Ironically, it's a 25-year history. I've been in business just over 25 years. So I've seen all of these rates, every one of them. Now we're going to come back up here and close, return back to rates, and we're going to return back to results. You can also look at the pay down summary. I love that. Again, this is your magic. This is what the client could save over $500,000. Could you imagine what they could put into some retirement investment funds or funding a kid's college, buying other properties, because you have the money instantly available. Again, like I said, you'll have a debit card with this. So if you have $100,000 available equity and you want to go and use that to put a down payment on another property that's going to turn investment, where you can totally use that. But I want to go down to the pay down summary. This right here is so cool, this pay down table. And again, here's the little description right here. The average minimum monthly payment on this one is just under $2,600. Minimum payment on here is $4,000. So out of the gate, your house payment just went down. And look at the average principal reduced monthly, just over $4,000 of principal being paid every single month. And that's how you're able to get that paid off in 11.5 years versus 30. This one right here, average principal is $1,500. And you can keep going and go right here, click the eyes and read those to the client. View pay down table is right here. This is where you can head to head looking at the all-in-one loan program versus traditional mortgage. Look at the power of this. 6 months into it, you've already paid over 14 grand towards principal. This one, $2,400. Let's go to year 2. Right there. Having a hard time getting to year 2 for some reason. There it is. So at 2 years into this loan, you're $60,000 paid principal. So that means you have $60,000 plus the 70, because remember the original balance was $560, but the line amount $630. So now you have $130,000 just 2 years into it. You can invest in other things. That is the power of this program. Whereas the 30-year fixed, it's fixed. The only way to access that equity is to refinance that first position into another 30-year fixed. Most people don't want to give up that under 4% rate because the rates are higher right now. The other opportunity is go out and get a second position HELOC. Yeah, you can do that. But history has shown us back in 2009, the mortgage meltdown, when people did have second position HELOCs, the values were coming down so quickly. What they did is a lot of them froze whatever balance they had in there or froze the limit. So they couldn't access any more money on that. They did not on any client reduce and or freeze the line amount on the all-in-one loan. Why? Because they perform. These are well-qualified individuals. And I will say this again, it's not for everybody. And also it's important to know that I am the licensed professional. And so it's best that I do these presentations to the client, not necessarily yourself. I'm doing this for educational purposes so you understand what the loan program does. Okay. And so you could take this all the way down here to 11 and a half years. Here we go. We're almost there. And we're there. So you can see we're paid down. They still have $88,000 almost to pay off on this house. And that's going to take them a bit of time. In other words, it's going to take them 18 and a half years more to get that paid down. And you can go on to buy other properties. And you're never going to have to chase the rate on this product, meaning people always want to know the two questions they typically ask someone licensed like myself is when they call us is what is the rate? What is the cost? Well, guess what? On this program, they don't have to chase the rate. They don't have to spend the cost of refinancing over and over to chase that rate and to reset their loan, because most people reset a loan every 5 to 7 years, whether it be they're buying another house and or they're refinancing. That's historical average. Okay, so we're going to return to summary. You can also look at this pay down graph, which is kind of cool. Kind of shows what the all-in-one does and where it does, the balance. Traditional mortgage principal balance, how long that far out is. This one's already paid off in 11 and a half years. It's a beautiful loan that hardly anyone knows about, including licensed originators as myself. So we're going to go back to the summary and to the results. And again, this is the coolest thing I love showing to people is right here. 138 payments, 360. Incredible. Without doing anything different. You don't have to go make extra principal payments. And what if you do get laid off from work for 3 months or 6 months? Guess what? You're paid ahead. You're not going to have to exit your house. And you don't have to dip into your savings per se, because that mortgage payment is typically the highest expense most people have. Okay, I hope you guys have learned something from this. This right here is where you can share and save. This is the key that I'm talking about. I'm going to click save and share. Again, here's the key. You can download this in a PDF. It's going to start doing this little thing here. As you can see, here's the all-in-one. You can send it out to as a PDF. And here's the key code that they can go back into and play with. I hope this has been helpful. I love showing you this program. You guys have been fantastic. If you have any questions, reach out to me or my team at 801-562-9100 or my cell at 801-557-8540. I will say the best way to get a hold of me is quick text and or jump on my calendar. And again, our company NMLS number is 117-2332. I hope you guys have a great, fantastic day. Thank you so much.